I think most average Joe investors are familiar with the quote commonly attributed to Ben Franklin, which reads like this: "In this world, nothing is certain except death and taxes." Technically though, the origins of this statement go back to 1716 from an English actor named Christopher Bullock with the quote, "'Tis impossible to be sure of anything but death and taxes." As Americans, we are more and more familiar with the idea that we cannot escape taxes. Or can we? In this video, I'm going to break down for you exactly how the United States government taxes dividends in tax year 2023, what constitutes a qualified dividend versus a non-qualified dividend, and how you as the average Joe investor can receive dividends from an awesome dividend ETF like SCHD, tax-free for life. We're going to talk a little bit about the Schwab US Dividend Equity ETF, ticker symbol SCHD, because it is by far the most well-known dividend ETF and the most popular. But in reality, what we're talking about in this video could apply to many different dividend stocks and dividend ETFs. First thing we need to be aware of is what exactly is the tax policy for dividends right now? Dividends are considered long-term capital gains. And based on the Tax Cuts and Jobs Act passed by President Trump in 2018, we have special rates through 2025 and 2026. We'll talk more about what the impact of those being removed actually is, but more on that later. The special tax rate for dividends is based on whether it's a qualified or a non-qualified dividend. And here are the rules by which we can determine if they are qualified. Qualified dividends come with the tax advantage of a lower tax rate. Three things usually determine whether a dividend is qualified. Number one, it has to be paid by a U.S. corporation or a qualifying foreign entity. And since most dividend ETFs like SCHD and others actually hold stocks that pay qualified dividends, they are also considered qualified. There's also the other big rule is that you have to hold the stock long enough. You have to hold it for 60 days prior to the record date, and you have to hold it for at least the 60 days afterward as well. So if you hold the stock or the dividend ETF based on these rules, it's considered a qualified dividend. So when you think of dividends paid from companies like Ford or ExxonMobil, Coca-Cola, Pepsi, these are all considered qualified dividends as long as you've held the stock for at least 60 days prior to the ex-dividend date, and you hold it for at least 60 days after as well. Here are the dividend tax rates for 2023 for qualified dividends. If you're single, you are in the 0% tax rate. That's right, the 0% tax rate as long as your taxable income is less than $44,625. And if you're married filing jointly, that tax bracket is even bigger, 0 to $89,250. Now, one thing we think about as well, okay, so it's 0 to $89,250, so as long as I make less than $89,250, I'm good to go, right? Well, yes and no. Actually, this is based on taxable income. This does not include your standard deduction. Let me show you what I mean. We're looking at the AARP website for their specific 1040 tax calculator. It's a way for you to roughly estimate your taxes for 2023. So let's go in here and assume that we are married filing jointly. We'll come down here, we'll go to filing status and dependents. We'll change it from single to married filing jointly. Then what we're going to do is we're going to go down to income from all other sources, assuming we're just earning dividend income. We'll come in here and we'll plug this into $89,250. That was the cap, where everything below that would be tax-free federally. If we change that to $89,250 and we close it up, you'll notice here that we have a standard or itemized deduction. So we're assuming the standard deduction right now, which would mean that our taxable income is not $89,250, it's actually $61,550 because we have that standard or itemized deduction. So technically we can take whatever that cap is, that $89,250, and add this number right here. We'll come up here, we'll change this from $89,250 to $116,950. That's the total when you add them together. $116,950 we're going to mark as ordinary and then also qualified dividends. This shows that after our standard deduction, our taxable income is $89,250, which shows that our estimated taxes are 0. Now this assumes that we're only receiving dividend income. This whole situation here would be different if you actually had W-2 wages or other types of income that would be taxed. But the important takeaway here is you could hold SCHD or Ford or ExxonMobil, Coca-Cola, Pepsi, McDonald's, all of these quality blue chip dividend stocks and just hold the stock, let them pay dividends, and you could earn up to $116,950 and pay no taxes. Now, a few things to keep in mind here. Number one, we're assuming that tax law doesn't change in the future. We are currently within the Tax Cuts and Jobs Act time window, and there could be potential changes to your tax rates in the future if these expire in 2025 and 2026. Specifically, here's the breakdown with how dividend taxes were adjusted based on the Tax Cuts and Jobs Act of 2018 passed by President Trump. Previously, taxes on capital gains and qualified dividends were 0 if you were below the 25% tax bracket, and then 15% in the 25 to 35% tax bracket. Whereas now it was 0 if taxable income is below 38,600 or single or 77,200 joint. These are based on 2018 numbers, which is why they're lower. Point is though that even before the Tax Cuts and Jobs Act, there was still a 0% tax rate for qualified dividends. It just was a little bit different than it is right now. We also don't know what state you live in, and certain states do have different tax laws when it comes to dividends, so you may be paying some state dividend taxes. I found a great article here that I will link in the description below, where it breaks down. It's a 2018 article, but it talked about the tax changes in 2018 based on the Tax Cuts and Jobs Act, known as TCJA. And it indicated pretty much here that there's essentially no change in the rates, 0, 15, and 20% for long-term capital gains and qualified dividends, and potentially the 3.8% net investment income tax for high earners. The difference is that the actual brackets for 0, 15, and 20 were adjusted and separated from the standard income tax brackets. Now, in a perfect world, you could avoid all future taxes by just investing in a Roth IRA if you qualify. So definitely worth taking a look to see if you can own dividend stocks in your Roth IRA as opposed to in a brokerage account. But just know that you can absolutely pay $0 in taxes on qualified dividends, such as those that you receive from SCHD, for life, as long as you stay within the 0% tax bracket. And I think most people, especially most average Joe investors out there, are going to stay below both that $89,250 bracket limit as well as the $116,000 one referenced. Hopefully you found some value in this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to all comments left on the day I post a new video. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.